When the market suddenly spikes, the natural impulse is to chase that move before it is too late. But by the time a massive candle is visible on a retail chart, the initial momentum has often peaked. Traders who jump in here usually provide the liquidity for the early participants to exit, leading to a late entry that gets stopped out as soon as the price retraces. If you observe the rhythm of any liquid market, you will see a consistent sequence. Large expansions in price are almost always preceded by periods of extreme narrowing. This alternating rhythm between silence and noise suggests that the most explosive moves don't come out of nowhere. They are the result of energy built up during moments of total calm. The inside bar is the specific price action pattern that captures this narrowing. It's a two-candle sequence. First, a large mother bar establishes a range. Then a second, smaller candle forms entirely within the high and low of that first bar. It represents a market that has stopped trending and started consolidating. This setup functions like a coiled spring. Because neither buyers nor sellers could push price beyond the previous candle's range, a truce has formed. As this truce continues, pending buy orders and sell stops begin to stack up just outside the mother bar's boundaries, creating a zone of high potential energy. Mastering this pattern allows you to stop reacting to moves that have already happened. Instead, you can identify these moments of compression and wait for the market to trigger the buildup of orders. However, an inside bar is not a guarantee of a breakout. When these patterns appear in the middle of a messy, sideways chart with no clear structure, they are often just noise. Amateur traders who trade every inside bar they see frequently find themselves caught in fake-outs, where the price clips the boundary and immediately reverses. To increase the probability of a successful trade, the compression needs to happen at a significant structural boundary. We look for these patterns where the price is actively testing a historical wall of supply or demand. An inside bar at major resistance shows momentum stalling at a historic ceiling. The resulting compression suggests a downward reversal. Conversely, an inside bar at a support floor indicates selling pressure is drying up, creating the potential for an upward bullish explosion. Without a historical level of support or resistance to provide leverage, the coiled spring has nothing to push against. Context acts as the primary filter, separating high-conviction signals from random market fluctuations. In a strong, trending market, these patterns take on a different role. Rather than a reversal, an inside bar during a trend often represents a brief pause, a moment for the market to catch its breath before the dominant move continues. To confirm that a pause is likely to lead to a trend continuation, professional traders use multi-timeframe alignment. If you find a bullish inside bar on a 4-hour chart, your next step is to check the daily chart. You are looking to ensure that the larger macro trend is also moving in that same upward direction. Trading in the direction of the higher timeframe trend is like swimming with a powerful current. When your local entry aligns with macro momentum, the probability of the breakout holding, rather than failing, is significantly higher. The most reliable signals emerge only when the short-term compression you see on your trading chart is backed by long-term momentum on the higher timeframes. There are two ways to trigger this trade. The aggressive entry places a pending order just beyond the mother bar's range, entering the split second the breakout begins. The conservative entry waits for a candle to close outside that range, proving momentum is genuine. The pattern provides clear risk definition. A stop loss goes outside the opposite end of the mother bar, showing exactly where the trade is invalidated. Once you know that distance, you adjust your position size so that if the stop loss is hit, you only lose a predetermined amount, typically 1 to 2% of your total account. Patience is the final requirement. Waiting for these specific structural alignments and entry triggers is the most effective way to filter out the false breakouts that occur in choppy markets. By isolating compression at key levels, calculating your mathematical risk, you stop chasing price and execute a repeatable process. You are no longer guessing at volatility. You are positioning yourself to benefit from it. Start mapping your support and resistance levels and look for the next period of market compression. You can trade these setups and refine your edge with the advanced tools of an FXNX One account.